The float game your bank plays. Okay, so here's something that genuinely broke my brain when I learned it. You know how when you deposit a check, sometimes it takes 2, 3, even 5 business days to clear? You're sitting there refreshing your app like, why is this taking so long? The money's right there. Well, actually, the money is right there, and it's earning interest, just not for you. This is called the float, and it's one of the oldest legal grifts in banking. Here's the mechanics. When a check or a transfer settles, there's a window, sometimes hours, sometimes days, where the bank is technically holding the money but hasn't released it to your account yet. During that window, that cash is pooled with billions of other people's pending deposits, and the bank lends it out overnight at whatever the federal funds rate happens to be. Currently, that's around 5%. Now, 5% of a few $1,000 over 3 days doesn't sound like much, but multiply that by every customer the bank has, every deposit, every transfer, every paycheck that lands on a Friday and clears on a Tuesday. JP Morgan alone earns somewhere in the ballpark of $2 billion a year on float income. With a B, that's money that technically was yours, sitting in your account, but the bank got the interest because they controlled the timing. And here's the part that's actually wild. The reason transfers in the US still take 3 days is not because the technology can't do it instantly. It can. Most of Europe does instant transfers. Most of the UK does instant transfers. Brazil does instant transfers. The US specifically maintains the 3-day delay because the float income is too profitable to give up. It's been a known issue for 2 decades. The infrastructure exists. The will doesn't. You personally lose maybe $20 to $50 a year to this, depending on your cash flow. Which is small, but the principle is the point. The system is designed so that the timing of your own money belongs to someone else, and they get paid on it before you can. Use accounts that offer instant transfers. Push for Zelle or FedNow when possible. Stop accepting that 5 business days is a fact of physics. It's a fact of profit. But float is just the surface layer. The next leak is way more aggressive, and it's specifically targeted at people who shop online, which, you know, is everyone. Surge pricing you didn't know you were in. Quick question. Have you ever opened an app, Uber, Amazon, a hotel booking site, a flight site, and noticed the price was different than what your friend was seeing for the exact same thing at the same time? You probably just shrugged and assumed it was a glitch. It wasn't a glitch. It was you. This is called dynamic pricing or personalized pricing, and it's running constantly in the background of basically every major consumer app. The algorithm is looking at signals, your device type, your zip code, your browsing history, whether you've abandoned the cart before, how often you check the app, your past willingness to accept higher prices, and quietly adjusting the price you see in real time. 2 people in the same building can be quoted different prices for the same Uber ride, and the more premium your behavior pattern looks, the more you get charged. Here's a specific example. Several investigations found that browsing for hotels on a MacBook returns prices that are on average 11% higher than the exact same hotels browsed from a Windows PC. Why? Because the hotel site's algorithms have figured out that Mac users statistically convert at higher prices. You're being charged a Mac tax that has nothing to do with the hotel and everything to do with the pixel resolution of your laptop. The same thing happens with delivery apps. If you order Uber Eats from the same restaurant twice a week for 3 months, the app slowly raises your prices by a few percent, testing how much you'll tolerate before you stop ordering. They call this elasticity testing. You call it dinner. It's the same dinner. It just costs you 8% more now because the system learned you'd pay it. The fix is annoying but effective. Use incognito mode for big purchases, flights, hotels, anything over $50 online. Clear cookies before checkout. Compare prices on a different device or with a VPN set to a lower income zip code. Sounds paranoid until you do it and watch the price drop $70 on the same flight. Across a year, this single habit saves the average online shopper somewhere between $400 and $800. Now this next one, this one had me genuinely angry because it's a leak that exists specifically because nobody bothered to tell you a piece of paperwork existed, the HSA you never heard of. Okay, so if your job offers health insurance, there's a chance, depending on your plan, that you're eligible for something called a health savings account, an HSA, and I'm going to tell you why this is mathematically the single best account in the entire American financial system, and nobody told you about it because nobody at HR onboarding has the bandwidth to explain it properly. Here's what an HSA does. You put money in pre-tax just like a 401k. So you don't pay income tax on what you contribute. That money grows, invested in the market, completely tax-free. And this is the part that's insane. When you eventually take it out for medical expenses, you don't pay tax on the withdrawal either. Triple tax advantaged. There is no other account in the United States that does this. None. The 401k taxes you on withdrawal. The Roth taxes you on contribution. The HSA taxes you on neither. Here's the move nobody tells you. You're not actually required to use the HSA for medical expenses in the year you contribute. You can pay for medical stuff out of pocket, keep the receipts, and let the HSA sit there compounding for 30 years. Then in retirement, you reimburse yourself for all those old receipts, pulling out tax-free money, basically converting it into a stealth retirement account that beats every other tax-advantaged vehicle on the market. The contribution limit is around $4,000 a year for an individual, $8,000 for a family. Max it out from age 25 to 65, and even at conservative market returns, you're looking at somewhere between $500,000 and $1 million sitting there, completely tax-free, for doing nothing different than what you'd already be doing, saving for the future. The catch is, you have to be enrolled in a high-deductible health plan to qualify, so it doesn't work for everyone. But if your job offers it, and you're young and healthy, and you're not on your parents' insurance, you are walking past one of the most powerful financial tools the IRS has ever accidentally allowed to exist, and almost nobody under 30 even knows it's there. But here's where the rabbit hole goes deeper, because while you're not using the HSA, there's another account specifically designed to drain money out of you in the most invisible way possible. The expense ratio, bleeding your future. If you have a 401k, pull up the statement right now, or more honestly, pull it up when this video's done, and look at one specific number that's hidden in the fine print, something called the expense ratio. Here's what it is. Every mutual fund and ETF in your 401k charges you an annual fee expressed as a percentage of your balance. The good ones charge 0.03%, 3 basis points. The bad ones charge 1.5%, 150 basis points. Sounds like a small difference, right? It's not. Let me show you with actual math. Say you have $100,000 in your 401k at age 35, you contribute $0 more, you let it ride to age 65, growing at 7% a year average. In a fund with a 0.03% expense ratio, you end up with around $750,000. In a fund with a 1.5% expense ratio, you end up with around $490,000. The fee ate $260,000 of your retirement from a number that looked like rounding error on the statement. And here's the worst part. Most 401k plans, especially at smaller companies, are stuffed with high expense ratio funds because the plan administrator gets a cut of those fees. Your HR department signs a contract with a financial firm, and that firm makes sure the menu of investment options is loaded with their high-fee products. They're not picking funds that maximize your return. They're picking funds that maximize their revenue. The conflict of interest is structural. The fix takes about 15 minutes. Log into your 401k portal, look at every fund you're invested in, find the expense ratio on each one. If any of them are over 0.2%, switch to the cheapest broad market index option available, usually something tracking the S&P 500 or a total market index. Most plans have at least one cheap option buried somewhere. Find it, move everything to it. You just gave yourself a six-figure raise that won't hit for 30 years but will hit absolutely. Now, if you thought that was buried in fine print, this next one is in fine print so small they're betting you'll never see it. And it's costing you every month you have a paycheck. The tax withholding trick nobody explains. Here's something that finance people know and almost nobody else does. Your tax refund is not a gift. It's not a bonus. It's not free money the government found and decided to send you. Your tax refund is your own paycheck, withheld for a year, returned to you with 0 interest. You loaned the federal government an average of $3,000 at 0%, and they handed it back in April with a smile. That's the simple version, and you've probably heard that one. Here's the version most people haven't heard, because there's a specific lever you can pull that almost nobody pulls. It's called your W-4 form. When you start a job, HR hands you a W-4. You fill it out, kind of guessing. You put 0 or 1 for dependents, and you move on with your life. That single form determines how much tax gets withheld from every paycheck for the rest of your time at that company. And here's the part nobody told you. You can adjust it whenever you want. You can submit a new W-4 to your HR department any week of the year, and it'll change your next paycheck. If you typically get a big refund, say $2,000 or more, that means you're over withholding, which means your real paycheck is smaller than it needs to be. By adjusting your W-4 to claim more allowances, you can shrink that refund to almost nothing and instead get an extra 150, 200 bucks per paycheck. Same total income, same total tax, just timed correctly so that the money is in your hands, not the IRS's, throughout the year. Why does this matter? Because that extra 200 a month dropped into a high-yield savings account or an index fund as it comes in earns you actual returns. The IRS doesn't pay you interest on your refund, the market does. Over a working career, the difference between getting your money throughout the year versus once a year in April is somewhere between $30,000 and $50,000 of extra wealth from a form that HR hands you that nobody explains. The reason this isn't taught is because it doesn't benefit anyone except you to teach it. The IRS likes the free loan. Your employer doesn't care. Tax prep companies actually prefer that you overwithhold because then you get a refund and they get to charge you to file it. The entire ecosystem benefits from your ignorance of a single piece of paperwork. Speaking of paperwork, the next one isn't paperwork at all. It's a default setting on something you use every single day and it's quietly costing you. The default tip: inflation. Your funding, pay attention next time you tap your card at a coffee shop or a takeout counter. The little screen flips around and it asks you to tip. But here's what's changed in the last few years. The default tip options used to be 15, 18, 20%. Now they're often 18, 20, 25, sometimes 30, and the highest one is pre-selected. This is called tip creep, and it's deliberate. Square, Toast, Clover, the major point-of-sale platforms, quietly adjusted their default tip suggestions upward over the last few years. They did it because the businesses they serve asked for it. They asked for it because they figured out that defaults work. When the screen suggests 25%, even people who would have tipped 18 will mostly just hit the suggested button because pushing the custom tip option feels rude. The whole system is designed to feel rude. Here's the math. The average American eats out or grabs takeout maybe 8 times a week. If the tip default creep pushed your average tip from 18% to 23%, that's an extra dollar or two per transaction, times 8 transactions, times 52 weeks. You're paying somewhere between $400 and $800 extra dollars a year in inflated tips on services that were never previously tipped at all in many cases: coffee shops, fast casual counters, takeout pickup, self-checkout kiosks. None of these were tipped categories 10 years ago. And here's the cultural sleight of hand. The tipping has expanded to cover the labor costs that the business used to cover itself. When you tip on takeout at a counter, you're not tipping for service. There was no service. You're subsidizing the wage of the worker because the owner doesn't want to raise prices visibly on the menu. So the tip went up, the wages stayed the same, the prices looked stable, and you ate the difference without noticing. The fix isn't to stop tipping. Tip generously where service actually happened. Sit-down restaurants, delivery, hair, anything where someone did labor for you specifically. But on takeout, on counter service, on self-checkout, on the dozen new contexts where tipping has crept in, you're allowed to hit the custom button. You're allowed to enter 10% or 5 or 0. The screen is designed to make that feel transgressive. It's not. It's just opting out of a system that was redesigned to extract more from you without anyone announcing it. Now, this last one is the one I genuinely think is the most overlooked of all, because it's not about a fee or a default. It's about a category of insurance most people don't even know exists. The insurance nobody sold you on purpose. If you're in your 20s or 30s and you don't have something called term life insurance, and you have any kind of financial dependence, or you plan to, there's a leak in your future you don't even know about yet. And the reason you don't know about it is because the insurance industry makes way more money pushing you toward the wrong kind of policy. Here's the setup. There are 2 main categories of life insurance: term and whole life. Term is the simple version. You pay a small premium each month, and if you die during the term, your family gets a payout. That's it. Cheap, clean, does the thing it's supposed to do. A healthy 25-year-old can lock in a $1 million 20-year term policy for around $20 a month. $20, the price of a couple beers. Whole life is the version the salespeople push you toward. It's also called permanent or cash value insurance. It costs 10 to 20 times more than term for the same coverage, somewhere between $200 and $500 a month. And the pitch is that part of your premium builds cash value that you can borrow against later, like a forced savings account with insurance attached. Here's what they don't tell you. The investment component of whole life returns, on average, between 2 and 4% annually. Less than a savings account, way less than an index fund. The fees are enormous. Sometimes 30 to 50% of your first year's premium goes to the salesperson as commission. And if you cancel in the first 10 years, you lose most of what you put in. Whole life policies are sold to young adults specifically because the salespeople make massive commissions on them. The math is so bad for the consumer that financial advisors who don't earn commissions almost universally recommend term instead. By term, invest the difference in an index fund, and you end up with more coverage, more cash, and no $800 a month bleed on your budget for the rest of your life. The number of young adults who get talked into whole life policies by a family friend who got into insurance is genuinely tragic. The lifetime cost of that one decision, over 40 years of paying inflated premiums versus the cheap term alternative, comes out to somewhere between $150,000 and $300,000 of net loss from a product designed specifically to feel like the responsible adult choice. So that's the 7. The float game, personalized pricing, the HSA you've never used, expense ratios eating your retirement, the W-4 you've never adjusted, tip creep, and the insurance product designed to be sold, not bought. None of these are about latte foam or budget apps. These are structural extractions built into the system, profiting off the assumption that you're not going to read the fine print or ask the next question. The actual $4,000 a year is hiding in plain sight, not because someone hid it, because nobody had a reason to point it out to you, until now. If this rewired anything in how you think about the system, drop a follow. There's more like this coming, and I'm going through every layer and in the comments. Which one of these 7 did you genuinely not know was a thing? Be honest. I want to see which one nobody told you about.